Hey traders, Nick Shaheen here looking at a quick lesson on diagonals. So options offer the ability to do single legs, calls or puts, or you do spreads, which are most everybody, when they say a spread, they mean a vertical spread where you buy one leg and sell another leg inside the same options contract. But sometimes if you move around the time, you end up with a calendar spread or a diagonal spread. So today is to address why would anyone would do something like this. So I just got an alert on Square. They reported earnings last night. Down, up, down, up. They can't make up their mind. But the alert is because I had an alert to trigger to let me know that it's above these two last failure points. And indeed, right now, it's not closed yet. Markets are open. So depends on where it closes, but this is encouraging to whoever is long. So there's also this little cluster right here. So that's the addressing the actual stock itself. The point of this video is not this. It's the fact that we need to address what the heck is a vertical instead of a vertical spread. What's the difference between the vertical and the diagonal spread? Okay, so earnings reactions are usually coin flips. We don't know how people are going to react to what the company's going to say. Even if you give me the P&L, I couldn't guess. Are they going to be happy? Are they not going to be happy? Roku delivered a strong quarter and it's down, whatever, 15, 16%. So you never know what the expectations are versus what the company says. Okay, so in this case, I usually don't risk a lot of money because it's a coin flip. It's Vegas. A lot of people say, oh, no, I'm going long all in. And, sometimes they win big. But same with going to the roulette table. I, bet a lot on red and I win big. But if I don't, I lose. And it's a coin flip and I have no control over it. I have no edge. So it's not really investing. It's more like guessing. So what I usually do is I take a small bite. How can I do it? I can leverage. So I do like Square, the stock. I want it to be long because given how long it's been down here, it consolidated, it built a base. So I thought that they would really have to stink up the joint in order to fall below this good consolidation base. So I do have some sort of an edge as far as logic. Okay, so this is a daily chart we're looking at. And it does have some catch up and it does have a huge gap up here. So I was going to go for the Hail Mary pass. So did I say it right? Okay. And go for the gold. So what did I do? I bought a calendar, a spread, but one that plays around with time and levels. So let me explain the difference. All right. So when I do a calendar, a vertical spread, I buy a call. Let's say I buy the December 70 call, right? And then I sell, say, the December 70, I don't know if they go by $1 or not, I can't remember now. Let's say this December 72.5 call above it. So what that does, it reduces my expense out of pocket because I bought one and I sold one. So it's still a net debit out of my pocket, but I limited my risk, but I also limited my potential profit. Okay, so if price is going to go to $1 million, if I had only bought this one, I would have, it cost $1.15-ish or something like that yesterday. I would be profiting for as long as the stock is rallying. Okay, as opposed to when I sell this one to limit my out-of-pocket expense yesterday, then I limit my risk. So how can I change this? So I can change it into a instead of a vertical call spread, I could change it into a calendar spread. What does that mean? So I could sell the December 70. Buy the December 70 just like I would, but instead of selling the December, whatever call above it, I would sell the shorter term call that is the same level. So let's say November 70 and collect some money. I would collect less money than this one, most likely, but at least I have a chance at unlimited profits. When I say I have a chance, because if I wake up the next morning today and the stock was up here, I lost money because I'm long and short at the same place and it cost me money to get there, so I lost a little bit of money. So I capped my profits way too badly. So how can I change this? So this would be a vertical call calendar. Doing this would be vertical call spread. Doing this would be a calendar spread because I played with time, calendar. So the third one is called a diagonal. And why is it called a diagonal? Because I do this. So I buy the same one, the December 70, which costs about $1 and change. I sell a shorter dated one and a little bit higher. So if I wake up and it's up in the moon, I still make some money because I'm long here and I'm short here, but I'm lower than the short. So there's some room to make money. It's easier to manage on the spike day. So real life numbers are as such, and let me bring it in here. All right, so this is the real life numbers from yesterday. So what I did is I bought a December 70 call, this one, and it cost me $1.17. And then I sold the one expiring this week, November 8th, 70.5 call, and that brought me 34 cents. So you say, why do I want to do that? Because this morning, even though the stock is spiking, it's up 5%. This one lost so much value. Whoever bought this from me, they thought it was going to go through and they're going to make money off of it. Lost money. They lost 29 cents. So chances are this is going to die for nothing. It's $65 right now. It's not going to spike another $5 before tomorrow. I could buy it back for a nickel. So the end result is my cost basis went down to 83, not to $1.17. So this morning, it's $1.17. Coincidence, right? So I can close the whole thing this morning and have made money, the difference between these two. Or I can stay in my $70 call and I only paid 83 cents for it and I'm already profitable in it. And I can sit in it to see if they're going to do this deal right here and fill this gap. So again, the lesson of today is not the actual trade itself. It's to illustrate the difference between a vertical call spread, which means I limit my profits and I buy and sell legs inside the same contract, December, or I change it into a calendar call spread where I buy a call in December, but I sell a call in a shorter time frame, let's say November or November 8th. Or I can even better my odds there because volatility was high in that stock for the week. I can do this, which means I buy the December same call. Instead of selling the calendar, same level, $70 level, I sell it higher. So the out-of-pocket expense is more than this. But the benefit, like you see, is really good because now I slept knowing that if it spikes, I'm okay. In hindsight, I probably should have done this, but hindsight is 20/20, as they say. But the point of this, again, is not the trade itself, is the difference between the three. Again, vertical call spread, calendar call spread, diagonal call spread. Diagonal just because it's diagonal. By the way, some people like to do this too. So they lower their out-of-pocket expense tremendously, but they take a risk because now they're at risk between these two because they're short here and long here. So this is kind of like a bear call spread, credit call spread, kind of. So temporarily they have risk, but then it disappears as soon as this dies, if it dies. Okay? All right, so this, by the way, works on puts. So same concept, all right? Debit put spread, I buy this put December, I sell this put December. This way. This would be a calendar put spread. I buy the same put. I sell one closer in time, same level. Or if I do this, now it becomes a diagonal put spread. Same concept. Nick signing out. Hopefully this shed some, options are not that dangerous if you just use common sense and really apply what you know about charts. And of course, the basis of all fundamentals. I mean, I don't do anything without fundamentals, but I definitely don't do anything without the charts either.